Welcome to another episode of Mirae Asset Sharekhan's quarterly sector review. I am Akshay Shetty, research analyst with Mirae Asset Sharekhan, and in this episode, we will discuss the performance of the cement sector in Q3FY26, key trends across companies, and what investors should watch going forward. Let's begin with a quick snapshot of the quarter. Cement companies under our coverage reported 16.6% YoY revenue growth, driven primarily by strong 18% YoY volume growth. However, realizations declined marginally by 0.2% YoY, reflecting pricing pressure in select regions. Despite lower per ton cost, EBITDA per ton declined 1.4% YoY as weaker realizations, especially in South and East India, offset operational efficiencies. Encouragingly, cement prices have started improving from January, supported by a pickup in demand. Industry demand for FY26 is expected to grow by 7 to 8%, with leading players likely to outperform the industry average. Now that we have seen the overall picture, let's break this down further, starting with volumes. Volume growth across major players remained healthy and exceeded the industry average growth of 6 to 7%. UltraTech delivered strong double-digit growth, while Shree Cement's growth remained modest as management focused on improving value and narrowing the pricing gap with competitors rather than chasing volumes. Now that we have discussed volumes, let's move on to realizations. The sector witnessed mixed pricing trends during the quarter. Cement prices declined in South and East India. Some companies saw a higher mix of non-trade sales, where pricing was relatively softer. Prices remained weak during October to November, but improved toward December as demand picked up. Overall realization either declined or showed only marginal improvement across most companies. Having covered price trends, let's now examine the cost structure and EBITDA per ton performance. Despite rising fuel costs, most companies managed to keep cost per ton flat or slightly lower through operational efficiencies and better cost management. UltraTech delivered the strongest cost performance, with cost per ton declining 6% YoY. Given the mixed trend in realizations and cost, EBITDA per ton performance varied across companies. UltraTech and Dalmia Bharat reported EBITDA per ton growth. Shree Cement, Ramco and JK Lakshmi saw some pressure on margins. Let's now turn to valuations and our investment recommendations. At current levels, we maintain a constructive stance on select names in the sector. We maintain a buy rating on UltraTech Cement, Grasim Industries, Dalmia Bharat and JK Lakshmi Cement. Having discussed valuation, let's conclude with the outlook. Looking ahead, cost pressure may arise from weak rupee, rising petcoke prices, and higher labor cost. However, companies expect to mitigate this through higher use of alternative fuels, operational efficiencies, passing on cost increase via price hike amid improving demand. Since January 2026, higher infra spending and greater construction activity have boosted prices and demand trends. Price increases are becoming visible across both trade and non-trade segments in several regions. Q4 is expected to be stronger than Q3, with industry demand projected to grow 7 to 8%, while leading companies are likely to continue outperforming with double-digit volume growth. We maintain a positive medium-term outlook on the cement sector. However, risks remain: macroeconomic slowdown, sustained pricing pressure, higher than expected input cost inflation. Among the players, UltraTech Cement continues to lead the sector. Shree Cement and Ramco Cement have relatively lagged this quarter. Our preferred picks remain UltraTech Cement, Grasim Industries. That concludes our quarterly sector review for the cement sector. Thank you for watching and stay tuned for more sector insights from Mirae Asset Sharekhan.
Investment in securities market is subject to market risk. Read all related documents carefully before investing.